To succeed in managing your money in today's complex financial landscape, it's crucial to understand that the traditional approach of relying solely on employer-provided pensions has evolved. With the disappearance of generous pension plans, individuals now play an active role in building and managing their own financial futures. In this journey, investing wisely and taking control of your pension become paramount. Seasoned investor Brian Portnoy provides a holistic guide to money management, addressing the challenges and opportunities individuals face in this new era. Throughout these blinks, you'll discover insights from unexpected sources, such as a 17th-century philosopher offering lessons in investment, the positive impact of humility and gratitude on both your psyche and wallet, and practical strategies for diversifying your investment portfolio to mitigate risks and avoid potential losses. By embracing these principles, you can navigate the intricacies of modern finance and make informed decisions to secure your financial well-being. Financial insecurity has become increasingly common, and the traditional approach to pension plans has shifted. Historically, pension plans gained prevalence in the 19th century as societies became more financially secure. However, recent decades have seen a significant change in how pensions are funded. Before the 1980s, employers largely funded retirement plans, but now individuals are expected to fund their own retirements, with self-funded options like 401k plans gaining popularity, particularly in the United States. This shift in funding has contributed to widespread financial insecurity. Statistics reveal a decline in the number of employees entitled to a full company pension and a rise in those self-funding their retirements through 401k plans. A survey by the Employee Benefit Research Institute in 2017 found that only 18% of Americans expected a comfortable retirement. Despite the need to take control of retirement funding, individuals often make poor investment decisions due to instinctual reactions during economic downturns. The tendency to hoard money in times of uncertainty, such as selling stocks during a market downturn, can undermine long-term financial goals. Contrary to instinct, the best time to buy stocks is often when prices are low, such as during an economic crisis. Overcoming these instinctual behaviors is crucial for building a secure financial future. In the upcoming blinks, we will explore tools and strategies to help individuals navigate the complexities of financial management and enhance their financial security. While financial insecurity may be on the rise, it doesn't condemn individuals to perpetual monetary misery. The human brain, despite its limitations, is a powerful tool for solving financial problems and gaining agency over one's financial life. Daniel Kahneman, a psychologist and economist, introduces the concept of fast thinking as the brain's default cognitive setting, involving automatic and instinctive reactions triggered by external events. Fast thinking is often responsible for impulsive financial decisions, such as overspending. However, Kahneman also highlights the existence of slow thinking, associated with rational thought and analytical processing of complex information. This slow brain setting enables individuals to engage in deliberate decision-making processes, such as calculating returns on investments. A study by social scientists Edward Deci and Richard Ryan suggests that approximately 60% of an individual's ability to make sound decisions and achieve happiness is influenced by genes and circumstances. While some decisions may be beyond control, around 40% of life decisions are conscious choices that individuals can make using their slow brains. In the following review, we will explore strategies to leverage the slow brain in making conscious and beneficial financial decisions, ultimately contributing to financial well-being and happiness. Welcome back to our knowledge haven. Your presence is genuinely valued. Immerse yourself in the enchanting realm of inspiring book summaries, teeming with actionable insights. Support us by interacting with the like, share, and subscribe buttons to broaden our reach. In return, anticipate enthralling book summaries that ignite action for your desired outcomes. Now, let's venture into the delightful journey back to the review. The 17th-century philosopher Blaise Pascal's perspective on belief and risk provides valuable insights into financial decision-making. Pascal proposed that the decision to believe in God is akin to a wager, and he argued that it is more rational to have faith because the potential rewards of believing in God outweigh the risks. Applying this concept to financial decisions, minimizing risk becomes a crucial aspect of sound money management. In financial matters, achieving the right balance between risk and reward is key. While taking more significant risks can lead to higher potential gains, it also exposes individuals to the possibility of substantial losses. For instance, the startup industry exemplifies this dichotomy. Successful ventures like Google or Facebook yield immense rewards, but a considerable majority of startups fail. To navigate the complex landscape of financial risks, the strategy is to minimize exposure to potential losses. Drawing a parallel with the insurance industry, where individuals protect their homes from financial risks by purchasing insurance, a similar principle can be applied to investments. Successful investors like Warren Buffett and Charlie Munger emphasize the importance of avoiding damage and limiting risks in their investment strategies. They patiently wait for favorable odds before making investment decisions, prioritizing risk prevention to ensure their bets have a higher likelihood of success. Starting your financial planning journey involves determining your net worth and setting clear financial goals. This process is both effective and straightforward. To calculate your net worth, begin by summing up all your assets, including your house, car, retirement fund, savings, and the value of individual items in your home. This total goes into one column. In a second column, list all your debts, such as your mortgage, credit card debts, college loans, and car loans. The difference between the total of assets and debts represents your net worth. Regularly perform this calculation, ideally annually, to track your financial progress over time. Understanding your net worth provides a comprehensive view of your current financial health. With this knowledge, you can proceed to set financial goals. Having clear objectives is fundamental to effective money management. While you can't predict all future needs, you can make reasonable estimates based on your current desires and requirements. For example, if you aim to make a $50,000 down payment on a $250,000 house in the next 5 years or have calculated the annual income needed for a comfortable retirement, having these goals in mind allows you to create a financial plan to achieve them. Regularly review your plan to assess whether you are on track or if adjustments are necessary to meet your objectives. This ongoing process ensures that your financial planning remains dynamic and aligned with your evolving needs and aspirations. Practicing gratitude has profound benefits for both your psychological well-being and your financial health. Beyond the tangible aspects of managing budgets and investments, acknowledging and expressing gratitude contributes significantly to overall happiness. Psychologist and gratitude expert Robert Emmons emphasizes the connection between thankfulness and happiness. Gratitude, he suggests, is a fundamental component of a joyful life. To cultivate gratitude, Emmons recommends 2 techniques. Firstly, take inventory of everything you already possess, avoiding the trap of comparing yourself to others. Reflect on your personal progress, fostering a sense of gratitude for your current circumstances. Secondly, acknowledge that your present situation results not only from your efforts but also from luck and the assistance of others. Cultivating humility becomes a foundation for gratitude, as recognizing and appreciating the contributions of others enhances feelings of happiness and contentment. Moreover, gratitude influences spending habits. Constant comparison with others can lead to a spending competition, pushing you to indulge in unnecessary luxuries. This behavior is neither financially prudent nor conducive to happiness. Gratitude, on the other hand, encourages contentment with what you have. If you are thankful for the essentials, you are less likely to engage in excessive spending or compete for status symbols. In essence, gratitude is a simple yet powerful practice that positively impacts both your soul and your wallet. In financial decision-making, the principle of simplicity often prevails over complexity. A historical example from the 1840s involving Dr. Ignaz Semmelweis illustrates this point. In a Vienna hospital, the death rate among women giving birth on Dr. Semmelweis's ward was 1 in 10, compared to a rate of 1 in 25 for women giving birth outside the hospital. The solution, with the benefit of hindsight, was simple hygiene. Doctors needed to wash their hands. The lesson is clear: simple answers are often the correct ones. Despite this, the human brain tends to favor complexity. More choices are equated with abundance, providing a sense of security and happiness. The preference for complexity is evident in various aspects of life, from extensive coffee menus to intricate financial plans. However, embracing simplicity in financial decisions can be financially prudent. 3 straightforward rules can guide this approach. 1. Buy low, sell high. This fundamental principle emphasizes the importance of purchasing assets when prices are low and selling them when prices are high. 2. Diversify your portfolio. The adage, "Don't put all your eggs in one basket," holds true. Diversifying your portfolio by investing in a variety of assets reduces risk. 3. Stick to your strategy. Avoid the temptation to constantly jump from one investment opportunity to the next. Consistency in your investment strategy is crucial. When it comes to investing, choosing simplicity involves understanding basic principles, such as investing in stocks for the long term and opting for bonds for short-term investments. The key is to choose trustworthy companies with strong products. Overall, simplicity in financial decisions can lead to better outcomes. Investing is not an exact science, and successful investors acknowledge the uncertainty inherent in financial markets. While finance is often portrayed as a realm governed by complex equations and algorithms, the reality is that predicting market movements with absolute precision is not possible. This realization, far from being a hindrance, actually levels the playing field, making it accessible to individuals who may not be mathematical geniuses with multiple PhDs. Charlie Munger, a highly successful investor, emphasizes that investors cannot predict precise outcomes. Instead, they aim to choose investments with a high likelihood of success. This perspective may seem like modesty, but it is a pragmatic approach. Acknowledging the element of chance in investing is crucial for making informed decisions, avoiding losses, and navigating the uncertainties of the financial markets. Practically, this means embracing humility and recognizing the limits of one's knowledge. Even for high-profile investors with access to vast financial information, understanding that it's impossible to predict every market outcome is essential. Contrary to the Hollywood image of aggressive and overconfident traders, the best investors prioritize humility. By doing so, they cultivate patience, stick to their investment strategies, and focus on crucial aspects like portfolio diversification and risk management. This approach proves more effective than impulsively chasing the latest trends or putting all funds into the most hyped investment options. While many individuals might anticipate a predictable average return on stock investments, such as 10%, the reality is more nuanced. According to data from the Ned Davis Research Group, the average yearly return on stock investments is indeed around 10%. However, this figure primarily reflects the average over the long term. In the initial years of an investment, returns might deviate from this average due to short-term fluctuations influenced by various factors, including company performance. These short-term swings can have a more substantial impact than long-term trends. It's essential to recognize that the range of potential outcomes for investments is broader and less predictable than a steady 10% return. The stock market exhibits significant highs and lows, with some years experiencing remarkable growth, such as a 167% increase, while other years witness sharp downturns, including a 67% contraction. In the early years after an investment, the range of positive and negative outcomes is substantial. However, the encouraging aspect is that the longer you maintain your investment, the more this range tends to diminish. Over the long run, the range may stabilize to, for example, between 0 and 20%, although minor losses may still occur. The key lesson is to avoid being overly influenced by the early fluctuations in your stock's value. Patience is crucial, as allowing your investment to weather short-term volatility increases the likelihood of a more stable and favorable outcome in the long term. The key takeaway from these insights is the importance of maintaining a realistic perspective in financial matters, acknowledging the role of luck in the financial markets, and embracing humility in investment decisions. Successful investing involves minimizing risks, avoiding impulsive decisions, and recognizing the unpredictability of market outcomes. Actionable advice: diversify your investment portfolio. Given the uncertainty inherent in financial markets, it's wise to diversify your investments across multiple companies or asset classes. Instead of putting all your funds into a single investment, spreading them across various options helps mitigate the impact of poor performance in any specific sector. Diversification provides a safety net, ensuring that the overall portfolio is less vulnerable to the fluctuations of individual stocks or assets. In my life's journey, my mission is to bring meaningful value to my fellow human beings, and I take immense pride in that purpose. Each day, my aspiration is to make a positive impact on someone's life when they wake up. Fortunately, your attention has connected us on this platform, driven by your thirst for knowledge and wisdom. To extend our reach to thousands, if not millions, of knowledge-hungry friends like yourself, I earnestly seek your help. A simple act of liking, sharing, commenting, and subscribing to the channel can make a significant difference. In return, I wholeheartedly commit to delivering impactful book reviews in a timely manner. Your support holds immense meaning to me, and I am truly grateful. Thank you for joining me on this journey.